Welcome to the Pacific Research Institute's Next Round podcast. I'm Rowena Ichon, COO, and with me, as always, is Tim Anaya, Vice President of Marketing and Communications. So another rainy day in California, Tim, at least in Southern California. I hope our listeners don't mind us talking about the weather because it really is weird for us to get all this rain. It's a big event.
Yes, we had another wild weekend of rain, but, it seems kind of prophetic that we've had rainy days in the sky. And according to the legislative analysts, we're having a rainy day in the budget as well. We just had the LAO came out with an updated forecast of the deficit, and recall the kind of brouhaha over, is it 38 billion? Is it 60 some odd billion? Is it 58 billion? Well, because tax revenues in December were so low, the administration estimated that we're about $5 billion below their budget proposal. Well, the LAO said it's even worse. They said, according to their projection, the deficit is about $15 billion higher, and they're now pegging it at $73 billion. Now, as a dollar amount, that would be the worst deficit in state history. As a percentage of the budget, it would not be. 2008-09 would beat that. But they make the point, and it's true. We need to start acting now to pull back one-time spending and temporary spending, because remember, the more changes you make early, the better lasting effect you have on the deficit as a whole. And we'll see what the governor and the new legislative leaders say about this, but we sure don't seem to be approaching this deficit with the urgency it requires.
So, Tim, the way it works is that the governor will come out with a budget revise in May. So there'll be a lot of horse trading going on in the next few months, I would think.
That's right. There'll be budget hearings all throughout the spring, and we'll be getting more updated tax revenue numbers. And remember, this year, barring a natural disaster like we had last year, we'll all pay our taxes on April 15th or thereabouts this year. So we'll have a better number in April as far as the state tax revenue picture. But yes, the May revise is, kind of represents some of the horse trading, but all of the certainly updating for the current economic picture of the state. It's really that May to June period before the final budget is enacted where you really get the horse trading. But as the legislative analysts noted, time is of the essence. We may not be able to wait until May or June, the traditional budget, to make these changes. We may need to make some of these mid-year adjustments now or fairly soon to achieve the level of savings we could if we act with urgency.
Well, Tim, as our listeners know, that California is one of the highest tax states in the country. And despite this, everyone, we're still going to see these huge deficits. But wanted to bring up this piece by our fellow John Seiler that really caught my eye. Californians might be blasé about the presidential election and think it's a done deal for us on Super Tuesday. But what isn't a done deal, at least not yet, are all of these tax increases that are in front of voters on March 5th. According to the California Taxpayers Association, there are 77 measures in city and county ballots to pay for various services and bonds. And that's a combined $350 million tax increase for Californians.
Well, and they're kind of sold as, well, it's a bond measure, you won't see it. It's for the children. It's not a big deal. And to be fair, local bond measures are common way and can be an appropriate way to pay for school infrastructure improvements. When we have state bond funds, which I think we've exhausted since we haven't had a state school bond for a while, they often require a local match. So it can be an appropriate way to pay for school infrastructure improvements. But the question always is not only the level of the tax increase, but also, well, what is that money going for? And we've had scandals in recent years with, well, is that money paying for like iPad giveaways to students? Or are we paying for we paying for lavish theaters on school campuses? Or are we paying for actual classrooms and laboratories and actual, facilities, not the luxuries? So, it's important, certainly in these economic times, voters should really look at your ballot carefully because, as John points out, you could get a rude awakening that you're not expecting.
Right. Tim, in my 20s, I used to be very naive about bond measures. I used to vote for most of them because I felt taxpayers don't take a hit and the bonds actually raise money. But what voters don't know is it crowds out other spending when you're paying those interest rates. And now John Seiler points out that a 30-year municipal bond is the rate is 3.6%. That's pretty significant. And not only that, over time, as a rule of thumb, that'll double. So right now, all these bond measures are total 3.6 billion over a 30-year period. That'll be 7.2 billion. So, it's no wonder that Californians really never get ahead and continue to pay so much in taxes. The burden is getting bigger and bigger, not just at the state level, but also at the local level.
That's right. So we will see how those go, and certainly who votes will determine the fate of those measures. Are people going to be drawn out by the Senate race and other things, or is it going to be pretty low turnout, which it seems to be? So it'll be very interesting in our election post-mortem to see how these measures do. So this week on the podcast, speaking of taxes and spending, we have a topic that we've covered a lot here at PRI, and that's the push for ESG. And of course, on the state side of things, ESG investing has been, there's been a push by the left for state pension funds to push for more ESG investing in their pension investment portfolios, which, as our Wayne Weingarten has cautioned, well, that actually is a troubling matter because the funds don't perform as well as traditional investment funds. And we have a duty to invest money in a way that's going to return the best bang for the buck for taxpayers and for retirees. So this week we have Paul Tice, who is a 40-year Wall Street guy, and he's written a terrific new book called The Race to Zero: How ESG Investing Will Crater the Global Financial System. And he goes into all of the background on ESG, how it's gained in popularity, and why you as an individual American should be concerned about its rise in investing philosophy and more sectors of our economy. So it's a very interesting book from a guy who's had a front row seat to these trends over the past 4 decades.
Thanks so much for listening, everyone. And here's Paul Tice. Paul, it's great to have you in the next round to discuss an issue that PRI has done a lot of work on in recent years, and that's ESG investing. So before we dive into your book, you have had a front row seat on Wall Street for more than 40 years. Share with our listeners a little bit about your background and what piqued your interest in writing a book about ESG investing.
Sure. Thank you for having me. It's a pleasure to be here. So my background is I worked for 40 years on Wall Street. I started as a junior at college way back in 1982, and I just called it a career in 2022. The first half of my career, I worked on the sell side in investment banking, mainly as a research analyst. And then the second half, I worked on the buy side as an investor at both hedge funds as well as asset management firms. Among the firms I worked at, JP Morgan, Lehman Brothers, Deutsche Bank, BlackRock would probably cover most of that period, but there were a few other smaller firms in between. And for most of my career, going all the way back to the 90s, I've specialized in the energy sector, both as an analyst covering it and as an investor. And that's kind of given me a front row seat, if you will, with regard to ESG, certainly over the last 10 years. And then in the last few years, I've been teaching down at NYU Stern as an adjunct of finance on a part-time basis. So that's my background. In writing the book, there were 2 main drivers. First was the issue that no one has really ever criticized ESG from within the industry. You never see anything critical coming out of Wall Street about why we're doing this, the illogic of a lot of the ESG argument. And that's for a reason. No one is really allowed to criticize or to disagree. So there's a definite cancel culture that's at play within the financial industry. And this is despite the fact that ESG is slowly changing the DNA of Wall Street. So, one of the main things I wanted to accomplish with the book was to kind of give voice to what I think is really a silent majority working on Wall Street right now that doesn't have the ability to speak out. And from my conversations that I've had over the years, I'm sure the arguments that I'm making will resonate with a lot of people still working on the street. And then the second main reason for writing the book was that even though over the last few years, there's obviously been more pushback and more of an anti-ESG movement, mainly outside of the industry, I think some of the focus and some of the tactics that have been employed up until now are somewhat misplaced. I would argue that rather than focusing on what's going on in corporate boardrooms and with woke companies, that we should really be focusing on what's going on in the financial markets when it comes to ESG, because that really is the fulcrum of the movement. And then second, a lot of these other ESG issues like diversity and equity and inclusion, those that fall more into the culture war category, not to minimize them as important issues, certainly for people with young children and families right now. But when you're talking about ESG, I think the focus really needs to remain on ESG. That is the primary priority goal of a lot of these activists. And that's where I think we need to train our focus if we're going to try and do something to stop it.
So let's start the discussion of your book with some of the basics. For our listeners who may not be familiar with the term, what is sustainable investing, and why has the push for it, as you write in the introduction to your book, kicked off a race to the bottom for Wall Street and a downward market spiral that will eventually crater the global financial system?
So when we talk about sustainable investing, ESG investing, responsible investing, they're all basically interchangeable terms. It's basically the theory that non-financial, environmental, social, and governance factors is what you should be using to drive corporate policy as well as investment policy, as opposed to objective financial metrics. And obviously, ESG factors are non-financial. They're also morally subjective. So this is a completely new way of doing things on Wall Street. And all of it is predicated on the theory of stakeholder capitalism, which has come in vogue over the last decade. Stakeholder capitalism basically argues that companies should not just focus on shareholders, their employees, their financial counterparties, but that companies need to be run for the benefit of society. The World Economic Forum obviously is a big champion of stakeholder capitalism, has been for the last 50 years. The way they frame it is that companies need to focus on people and planet. And obviously, just looking at that from a layman's perspective, obviously that's unworkable if you're running a company, if you're an investor in a company. But that is basically the core argument of ESG. Why is it bad for the markets? And why will it lead to a downward spiral, as I argue in the book? Well, the main reason is because ESG is not a populist fad. This is not a bottoms-up approach that's being driven by investor demand or market demand. It's a compulsory system that's being imposed on the market. It's primarily being spread by third-party activists using primarily moral duress in the early years, and then now government force. And we're reaching that point in the ESG time cycle where regulations are now being put in place to cement all of this agenda into place. So it's a coercive system. Everyone is under pressure to comply. And since I have an energy background, the best analogy I could use for you is that it's like a natural gas pipeline. A pipeline basically works like a balloon. You put in a molecule of gas at point A, you take it out at point B. The only thing that allows you to do that is if the entire system is kept under pressure. So you need to put compression stations all along the pipeline route. ESG is just like that. Companies are under pressure to comply from investors, right? Asset owners, asset managers. And that in turn, those investors are under pressure from third-party activists to comply. So it's all about controlling the markets and controlling the people that work on Wall Street. ESG is designed to remove their agency. It forces them to look to an outside third party to make a decision on everything around an investment from a sustainability perspective. The best analogy I can give you would be, if you're playing a round of golf and for every shot you had to call in a PGA official for a ruling, that would make for a very long day on the links. And it's kind of like that with ESG on Wall Street. The people who are working in the markets day to day, picking stocks and bonds, determining relative value for countless securities, they can't do that using an ESG framework because it's so subjective. You have to defer to so-called outside experts. So it's about controlling the people. Primarily, it's also about controlling the capital flows. And ESG is similar to, the Chinese social credit score as a means of control. So, the goal is to direct capital where you want it. And that starts with directing it away from fossil fuels and towards renewable energy. And then lastly, why this is all bad for the market. And this is a point that no one really focuses on. And I think it's critical. But in all the talk about climate change, the need to get to net zero, transitioning energy away from fossil fuels, no one talks about how that scenario playing out is going to be negative for the financial market. Everyone assumes it's going to be positive, but given the technology constraints that we have right now, that transition can't work. So decarbonization is going to lead to degrowth and deindustrialization and probably increased poverty and unreliable electricity grids. I can't see how that scenario is going to be positive for the financial markets or the macro economy, and no one's really talking about that reality.
You write that even though the progressive movement took a drubbing during the Reagan era of the 80s, they simply retreated for a bit, regrouped, and reemerged more determined than ever before under the banner of ESG, sustainable investing, and concern about climate change. So in your view, what explains how they have been able to become so successful today with ideas that were largely discredited 40 years ago?
Well, I would argue that you can view ESG as kind of the latest point on a continuum with regard to the agenda of progressives. And if you go back to the 1980s, I argue in the book that was the point where, a lot of liberal progressives kind of receded into the background and adopted asymmetrical warfare when it came to achieving their goals. And so you've seen that the infiltration by progressives of all of the pillars of society in this country, that's true also across the rest of the developed West. But in this country, you can see that each of those pillars has slowly fallen to a progressive agenda since the 1980s. First, you had public schools, then the colleges and the universities, the media, the arts, organized religion, and now you have business and the financial markets as the last institution, in this controlled demolition, really, of society. And so you need to view it as just the latest to fall. But it's been a process, because it has been asymmetrical and kind of a rearguard action, that there's been no public debate about what we're doing. It's being achieved in very non-democratic means. And if you look with regard to ESG, it is primarily the United Nations taking the lead, and then nonprofits and NGOs like the World Economic Forum that are the ones that are mainly pushing this agenda behind the scene. And if you look at all of those institutions, it's almost a permanent class of government bureaucrats that are recycled from national governments up to some of these supranationals and international NGOs and then back. So we can't fix this with the ballot box, although there's one exception to that, which we could talk about in a little while. But up until now, there's been no public referendum on it. So while I think many of us and many Americans would agree that a lot of these ideas are discredited, they're not going away, and they are slowly being implemented, mainly through the courts as well as through the executive agencies. So I think we need to look at ESG as the third leg of the stool, climate change, sustainable development being the other two, that it has been led primarily by the UN since the late 80s. And I will note that they use the same tactics to implement a lot of these different verticals. So with ESG, you see the same type of shutdown of any dissent which replicates what's been going on around climate change for the last 30 plus years. There are climate deniers. That's the easy criticism for anyone who questions what's going on. I think ESG denier is going to be coming in vogue probably over the next few years going forward. But I guess the main point is that the progressives pushing this, who reside at national governments as well as supranational agencies and NGOs, they're playing a very long game. We're 40 years into it, and there's a lot of political capital that's been invested in it. So it's not going to be easy to turn around at this late date.
Let's follow up on that point for a minute. You mentioned that sustainable investing has taken a much stronger hold in Europe and global institutions, while it is clearly gaining momentum in the United States. So what explains, in your view, why ESG has become so dominant a worldview in these global institutions? And, how, as the title of your chapter suggests, does the UN want to be our investment advisor?
Well, I would argue that the UN and a lot of the supranational agencies created, out of the aftermath of World War II, they all had a collective approach. So I think that's ingrained in their genetic material. I think Europe, post-war Europe, has also had more of a collective bent. I mean, you certainly see that over the last 25 years with the move to a common currency and then the EU structure, where arguably all the member states there have ceded a lot of their economic and political sovereignty to bureaucrats in Brussels. So I think Europe's been of the same collective mindset really since World War II. But if you look back in the 1980s, clearly there was a mandate shift at the UN where, they didn't make an announcement about it, but clearly there was a move to, shift to more of an environmental and social agenda, as opposed to their real mandate or their original mandate, which was to maintain peace and order on the planet. So they focus more on a liberal progressive agenda, and I think it's a means to political control and power. That's the only explanation that you have for a lot of this. And, if I'm correct in my argument that climate change is the core of all of this around ESG, if you control emissions, you control the world economy. So, I think this is all about maximizing political control. And there clearly has been a change since the 1980s at the UN, and all of that has had the full support of the European member governments. I don't think it's surprising that the Paris Agreement in 2015 was in Paris, in Europe, right? The sustainable development concept was rolled out in 1987 in a commission that was chaired by the Norwegian Prime Minister, right? So I think Europe has ingrained a lot of this agenda for decades now. The point about the UN wanting to be your investment advisor, I think that probably is the worst example of strategy drift that you have at that institution over the last 80 years, because clearly they have no place giving investment advice, ESG related or not, and they're not experts in finance. But that hasn't stopped the UN from trying to, complete the last leg of the stool by basically taking control of the financial markets. So that started back in 2006. When the UN set up Principles for Responsible Investment, which is basically, the leading ESG advocacy group on Wall Street. It currently has 5,400 members. And if you look at the AUM, assets under management, for its membership, it basically covers every investor in the market right now. So it's got a very wide reach. Now, originally, companies, investors joined the PRI in order to signal their virtue, frankly. And the group was named, I think, with that in mind, because rather than choosing a sustainable tag or anything related to ESG, they call themselves Principles for Responsible Investment. The implication being, if you're not part of our group, you're acting irresponsibly. So I think virtue signaling was the original incentive for a lot of Wall Street firms to join the PRI. And they were also promised walking in the door that when it comes to ESG and sustainability, you can use your own custom approach, whatever works for you. So bespoke was kind of okay for all of the members that were joining. And that slowly has changed over the last few years, particularly since 2015, with the passage of the Paris Agreement, as well as the 2030 Sustainable Development Goals by the UN. Now, the PRI is arguing that good good ESG implementation requires alignment with both of those UN treaties, right? So they've been moving the goalpost on members since they joined. And it's very tough for these companies to leave, because how do you leave a group that you joined in order to signal your virtue? You either have to admit that you were duped by what they were selling, or you're not virtuous enough to maintain your membership. So either creates an awkward conversation. So no major Wall Street firm has ever left the PRI over the last 18 years, even though their requirements in terms of reporting and compliance have stepped up almost every year. And they require 6 principles of all of their membership. You have to integrate ESG, you have to engage with all your companies, you have to promote sustainability in public, you have to collaborate with other investors on ESG, and then you have to fill out yearly reports showing your compliance with all of the principles. So it's a very Orwellian group. And for them, climate change is the #1 ESG priority. It's the means to the end of creating what they envision as a sustainable global financial system by 2030. So it's all about climate change. And it has a lot of influence on Wall Street right now.
So in your book, you trace the rise of ESG investing in the U.S. in part to the 2008 financial crisis. Paint the picture for us. How did a financial crisis over bad lending practices pave the way for the push for activist control of Wall Street, corporate America, and our investment portfolios?
So, and at the time of the crisis, I was working at Lehman Brothers, so that gave me another front row seat to what was going on in the markets. But I think the primary reason why the crisis has kind of laid the groundwork for ESG is first that coming out of the crisis, the entire industry, the survivors that is, needed to burnish their ethical image. During the early days of the Obama administration, really through both terms, when you think about it, we heard that Wall Street had wrecked Main Street in the crisis, even though the subprime mortgage lending issues were because of bad government policy that was pushed onto the markets, right? There was also obviously individual firms that had problems managing leverage and risk, but the real contagion that started spreading was in the subprime market, and that was the responsibility of government. But don't let the facts get in the way of a good narrative. So there was that one thing. Also, I think the main takeaway from Lehman's bankruptcy is that companies on Wall Street need to stay on the good side of the government, because back in 2008, it was the government that decided which firms survived, got absorbed by competitors, and which firms didn't. And if you look at the tape, it was really only Lehman Brothers that didn't, that was forced to file for bankruptcy. So I think that message continues to resonate with the firms on Wall Street. And to the extent that that message wasn't clear coming out of 2008, the government has reinforced it with a series of lawsuits that has led to billions of dollars of legal settlements from Wall Street, and then also a new wave of regulation, starting with Dodd-Frank, the Volcker Rule, some of which is peeled back, but most of which is still in place. And so the industry now is kind of consumed with compliance, and all of that taken together kind of makes the industry more risk averse. So I think that is an important contributor. But I think also if you look at market conditions post-crisis, that also has kind of like laid the groundwork for ESG, because obviously Fed policy has been very accommodative since 2009. We've had 0 interest rates up until recently, arguably much longer than we should have. And that's been compounded by quantitative easing. So that, I think, has conditioned the markets to take its cues and direction from government. Fundamentals kind of went out the window when the only thing that matters is really what's the Fed going to do next. So I think that's kind of undermined and decayed a lot of the analytical skills on Wall Street over the past decade. The absence of volatility up until the pandemic in 2020 has led the market to kind of grasp at new ideas and new shiny objects. AI, big data, cryptocurrency is probably the worst example. And I think ESG is just the latest shiniest object kind of in that process. An analogy to throw out for you in terms of Wall Street kind of laying the groundwork for ESG. If you have a lawn that's been burned out, hasn't rained for days, right? Your lawn gets burned out and then it does rain. What grows back? Weeds, right? The grass doesn't recover. It takes a long time for that. And I think it's that kind of analogy to keep in mind around Wall Street. I think Wall Street is less innovative. It's much more of a manufacturing facility right now than it was before. And I think a lot of that is because no one wants to get offside with the government and the regulators. And I think ESG is part of that. Another reason why you're not seeing a lot of people speak out about it.
So, as PRI's Dr. Wayne Weingarten has documented in our research on ESG, a $10,000 investment in ESG funds returned 43.9% less over a 10-year period than a similar investment in a regular S&P fund. So, as you write in your book, there's a paralysis of good Wall Street research when it comes to ESG investing. Well, in your view, why is that? And if ESG investing is not very successful, as Wayne's found in our research, well, aren't Wall Street firms really failing in their fiduciary responsibilities by not carrying out and publicizing the significant research required here?
Yeah, I think part of that is just everyone is under the gun not to speak out in public. But I think with ESG, the reason why it kind of paralyzes normal Wall Street analysis and decision making is because it has a quantitative patina to it, ESG, that is. It has a framework, it has all of these different metrics, but all of them are random and they're subjective, and they don't translate or impact financial performance. A lot of it is just minutia, which gets in the way. To give you an example, there are 17 Sustainable Development Goals according to the UN, and they've translated that into 169 themes, and then they've come up with 232 ESG metrics to go along with that. So if you're a normal Wall Street analyst, either on the equity or the debt side, you probably cover 50 to 75 companies. So that translates into roughly 15,000 data points for your coverage universe. It's completely unworkable. You can't use it to make, relative value decisions on a rational basis. So a lot of the system is very cumbersome and chaotic. If you look at the two major ESG rating firms, MSCI and Sustainalytics, every one of their company reports is 100 pages. If you just do the math, you would spend all your time reading these third-party research reports, right? None of which are consistent with each other because everyone does ESG their own way, including the so-called third-party experts. So a lot of this chaos, I think, is by design, and it lays the pretext that we need regulators to step in and kind of standardize everything so that we can protect investors. And you've seen that in the SEC and over in Europe recently with some of these greenwashing arguments. It's chaotic because it's not financial. Is it a fiduciary problem? On a number of fronts, yes, it clearly is. If ESG is not driving financial asset prices, which it's not, I think the best example would be the energy sector outperformed significantly in 2021 and 2022. That should not be happening if everyone is adhering to an ESG approach. So, ESG doesn't drive financial asset prices, so it can never outperform as an investment strategy. The numbers that you cite in the Weingarten study are not surprising. ESG, depending on when you look at it, it may outperform because it has a technology and a consumer bias. It also may have a bias against energy. So since energy is a cyclical sector, at any points in time, they could be underperforming significantly. Like 2014 through 2018, I would argue, if you look at sustainability, it outperformed, but that's only because you were going through a cyclical and secular restructuring of the energy sector. And there's been a lot of academic research that's been published over the last several years trying to make the case that ESG does lead to better company performance and better investment performance. But all of the studies that they publish, kind of come up with the same kind of inconclusive findings, but it doesn't stop them from printing and keeping on looking. One statistic for you, NYU did a study in 2021, and it was a metadata study, and they looked at about 2,700 direct studies on ESG that have been performed between 2015 and 21, and that was 80% of the market. So that means roughly 3,400 papers were published on ESG over a 6-year period, which works out to 1.5 papers per day. So the ESG research, in the academic sphere is really cranking up and catching up with what we've seen on the climate research side. I would say that if we need to publish this much research to make the case, maybe there is no argument. And right now, if you look at all of the data, and I go through this in the book, really there's nothing conclusive that proves it. For no lack of trying. So, I think that creates a fiduciary problem that you can't demonstrate that outperformance over an extended period of time. But if you look at the opposition from ESG, they're realizing that and they're kind of reframing their argument. So, return is now being adjusted to risk-adjusted return. And, adjusting for risk factors means that you're willing to accept lower return on an absolute basis. So that's kind of a subtle change in the last few years. And then increasingly, we're hearing talk that we can't focus on return. We should focus on impact, right? So we're changing what the objective is. And when you talk about impact, the only real way to measure that is by how much capital you're throwing at particular industries and companies that align with what you're trying to do. So they're slowly changing the goalposts there. And the last point I would make, in the Weingarten study, if you're looking at sustainable funds that have been raised with a sustainable mandate, whatever that is, and that's been clearly communicated to investors and it's new capital, I don't think that's a fiduciary problem, right? Those investors have to own that performance, right? So if that's all we were talking about with regard to ESG, I don't think there would be a fiduciary problem as long as everyone went into it heads up. The problem with ESG is, again, it's coercive. And for the 3 trillion or so of sustainable funds that have been raised, if you look at the Morningstar data over the last decade or so, that compares to 97 trillion of non-ESG funds. All of those non-ESG funds are seeing ESG integrated into their decision-making. That, I think, is the biggest fiduciary problem that we have around sustainability right now on Wall Street, and that no one is really focusing on.
So you quote Milton Friedman's longstanding view that the one and only one social responsibility of business is to increase its profits so long as it stays within the rules of the game. As we're seeing from the Business Roundtable on down, that's not the view on Wall Street any longer. So this begs the question, if ESG investments are bad ones, then why are so many so quick to embrace it? It would seem that making charitable investments to nonprofits would be a far better way to promote the environment and liberal political causes than investing in losing funds.
Yeah, when I got my MBA back in the 80s at Stern, Milton Friedman was, the prevalent view when it came to corporate responsibility and business ethics. And obviously that's changed a lot at most universities, including Stern, I would argue. And part of that may be also additional fallout from the global financial crisis. I think that weakened, the finance departments at a lot of universities. And that's also kind of strengthened the sustainable business argument coming from other areas of the university. So another, crisis, unintended consequence. I would agree with your point about charity. The way up until now that it's worked is that if you have a strong view about improving society, the environment, whatever your goal is, you make the money first, and then you allow individuals to direct that based on their personal preferences. With ESG, we're kind of changing that process, and we're forcing the markets to do that when it should be a personal choice. But again, it's all about control. It's all about controlling the capital flows in the market. And that's why, that charitable avenue doesn't work if you're an ESG activist. I mean, the goal is to commandeer the global financial market. There are trillions of dollars of capital flows every day. If you could harness that and basically harness all of the private sector funding to implement what is a government-directed agenda, that is what they're going to do. And so that's what the ultimate goal here is. And Milton Friedman's fallen out of favor as stakeholder capitalism, as proposed by Klaus Schwab, has developed a new ascendancy. But stakeholder capitalism is not capitalism. It's not free market capitalism. It's basically state-directed capitalism. Really, it's state-directed socialism, once you get down to it. I mean, you're trying to control, free market. And obviously, there are going to be a lot of unintended consequences if this continues down this path. There hasn't been a lot of public pushback, as I mentioned before, because a lot of people, the rank and file that work on Wall Street, can't speak out. And I think generationally, you can make the argument that more experienced people on Wall Street probably have a different view than some of the younger people that have just started out and have learned and been indoctrinated with a lot of this agenda in university and business schools, right? So I think there's that bifurcation in terms of the people working in the industry, but the end result is no one can really have a contrarian opinion. And I know that firsthand. But I think the other problem too about speaking out is you have to get into an immediate discussion about climate change, because climate change is the core goal, the number one ESG priority. And I think a lot of people don't feel confident enough or want to be to have that discussion in public. A lot of politicians don't want to have that discussion in public, and so no one wants to throw that first punch. Even energy companies, CEOs that run major U.S. energy companies don't want to get into a difficult climate conversation. And we're going to have to do that, I think, at some point to reverse, the forward momentum here. Then the last point, I think, is, there's a lot of rank and file on Wall Street that don't agree with this. There are a lot of CEOs also who don't agree with this, but they also can't speak out. Not every Wall Street CEO is a true believer like Larry Fink, who runs BlackRock. He's been very outspoken. His CEO letters have been, pushing sustainability for years now. But for Larry Fink, there's probably two or more other CEOs that can't speak freely in public because then they become the target, right? Then protesters will focus on them, right? So again, it's just all this pressurized system where no one is allowed to speak freely. So we have to come up with a solution that removes all of the pressure on the industry so the markets can be free again.
Following up on that, I think it's quite chilling, the stories you tell in your book about this group that you term the village of ESG enablers, or these protesters and activists and pension fund leaders and politicians and government officials who've made really a cottage industry of their shareholder activism. So could you share a couple of examples of these activists and why, in your view, ESG is really becoming the social control network?
Yeah, so a lot of people are trying to make money off of ESG. I would argue that most investors are losing money because of the added expense and overhead related to ESG that they didn't sign up for. But there are a lot of service firms and others that are trying to make a quick buck off of it, or at least become the incumbent in the industry as it rationalizes. So you've got rating companies, MSCI and Sustainalytics would be the leaders. By one count, there are 140 companies out there that are issuing ESG scores, which is mind-boggling. And again, all of them have their own approach. So it's not creating for a rational market. And you have data aggregators, you have index providers, you have AI companies who have services that scrape for headlines worldwide, anything related to an ESG issue. The proxy advisory firms, ISS and Glass Lewis, they reconfigured their advisory program to basically reflect the ESG agenda. And then all the consulting firms, particularly McKinsey, have established sustainability as a new business vertical within their complex. And then, as I mentioned before, the academics, you've seen the rise of all these sustainable business centers. There's more than 200 worldwide now that are in residence at business schools. They're putting out a lot of ESG research, which I would characterize more as propaganda. And then there's the other class of what I would call politician government officials who are trying to make money. I think grifter is a fair description of some of them. Again, a lot of the people around this, even some of the service providers, they cross over into advocacy. They have a conflict of interest, right? No one talks about all of the inherent conflicts that you have with everyone who's gearing up around ESG. Sustainable activists were very quick to point the finger at the energy industry and for making a bad faith argument just because they're trying to defend themselves. But no one ever raises, what I think is a bigger issue when it comes to a lot of the ESG activists that are now disguising themselves and pushing this onto the market. So in the political class, obviously you have Al Gore. He has parlayed his climate change hectoring over the last 25 years and now runs a sustainable investment firm, Generation. You have Mark Carney, who used to be the governor of the Bank of England, the Bank of Canada. He headed up the Financial Stability Board of the G20, which came up with the task force on climate-related financial disclosures. He was also at the Conference of the Parties 26, where he was trying to sign up financial institutions for a net zero agreement. And his day job right now is at Brookfield Asset Management, where he has oversight responsibilities for their transition and renewable investment, right? Clearly a conflict, I think. And then lastly, you have Bloomberg, which, is trying to be the go-to hub for all ESG related market news and data, similar to all of the financial market information that they've captured on their system. But if you look at Bloomberg, obviously he's very wealthy, and a lot of his money is being used for climate initiatives and also for ESG related initiatives. So he was the chair of the task force for climate related financial disclosure that Mark Carney was involved with. He also founded an organization called the Sustainable Accounting Standards Board, which has a very official sounding name. It's not an official group, but many people confuse it with FASB, and they come up with their reporting and accounting standards for sustainable related issues. So you have a lot of these nonprofit organizations, quasi-official sounding, that are coming up around ESG that people really need to kind of scratch the surface on to see exactly who's behind them. And obviously everything that's said about ESG or climate change drives more business onto Bloomberg's platform. So, I think more focus needs to be made on the conflicts of interest that you have with the people involved with pushing ESG on the market. But the point about it being a social control network, I do think there are a lot of similarities to what China's doing with its own individual credit scores. If you look at ESG and the normal process that the PRI, not you guys, the PRI, but the UN's PRI, they argue that every investor has to engage with their companies. And the first part of that engagement is asking for more disclosure around ESG metrics, right? And if this was normal analysis, once you got your hands on the numbers, the people working in Wall Street could come up with a view on value and where things should trade. But it's not normal analysis. Once you get a lot of these ESG metrics, which in particular around emissions, then the next phase in the ESG process is to make demands for your portfolio companies to change their behavior, cut back on their emissions, oil and gas production, electricity use, what have you. So it's not typical analysis. And then if those demands are not met, then there's an escalation process. And that could be a challenge, a legal challenge, a lawsuit. It could be a proxy battle during the spring shareholder meeting season, or it could just be pop-up protests that show up at your headquarters or your annual meeting with a giant blow-up rack, right? So again, it's a pressure system and it's designed to keep everyone in line, but it's not analysis.
As you've documented in your book, we're headed toward a complete reset and re-engineering of the capital markets by 2030. Of course, we still have time to put a stop to these bad policies that would threaten America's wealth, economic health, and our retirement plans. So what are some of the things that policymakers can do to slow down or stop the ESG takeover of our economy? And what can regular Americans, whether active investors or investors through their 401k plans, do to voice their displeasure with how their investment dollars are being invested, perhaps in violation of their political and economic philosophy? Regular Americans are big investors too. So despite the loud megaphones carried by the proponents of ESG, they can do something about it.
Well, I would say when it comes to individual Americans, definitely don't patronize any company, whether it's Target, Anheuser-Busch, Disney, that doesn't align with your personal values. And I think the same argument should be made around whoever manages your money. So if you have an issue with your investment advisor in terms of their ESG leanings or anything else, then you should pull your money and give it to someone, again, that you feel more comfortable with. I think the best thing that individual Americans can do and consumers is to give an earful to policymakers. And since ESG is basically a political issue, it's progressive politics. The other side tries to shut down any sort of debate by just accusing anti-ESG proponents as being hyper political. But it is politics, and we need to embrace that and just move past it to have a further discussion. So if we're going to try and roll this back, it's going to require a political solution. And here I think we have to look just to the Republican side, unfortunately, because everyone on the Democratic side is lockstep with climate change and ESG policy. A letter writing campaign, voicing yourself with your Republican representatives, particularly at the state level, I think will go a lot, because they're going to need to lead the charge here to reverse this. And as I mentioned before, since this has been a non-democratic process primarily in this country, by which climate policy and ESG policy has been implemented through the courts as well as through regulators, that's the way that we're going to have to reverse it. I think policymakers need to have a two-pronged attack in order to accomplish this. First, we need to dismantle and legally challenge all of the ESG rules that are now currently pending from the Biden administration. And that would include from the SEC, the FDIC, the OCC, the Federal Reserve, the Department of Labor. And then also a view needs to be taken on how regulations from Europe, from the UK and the EU with regard to sustainable finance will be leaking into our market over the next couple of years. And Europe, again, has been more aggressive with these policies, and the markets are integrated. So I think that's another front that Republicans need to take a look at. But I think there needs to be pushback on all these ESG rules. And then also we need to backward integrate. I think we need to attack a lot of the climate regulations that are now in place that, again, Congress never voted on. They've been implemented through the back door. So that would include the 2009 endangerment finding by the Obama administration. I would take it a further step and revisit the Massachusetts versus EPA ruling by the Supreme Court back in 2007, which I think was a flawed ruling. I think the current court would come up with a different view based on updated data. And then I think, primarily we have to take a look at the extra-legal way by which the Paris Agreement and the 2030 Sustainable Development Goals have kind of passed into passage in this country without being ratified by the Senate, right? So that's extra-legal. They passed by executive order, or on the SDG side, a lot of them are being implemented at the city and state level, right? So, I think we need to have, a return to constitutional order around this. They need to be submitted to the Senate, and then hopefully there are enough right-minded Republicans there to vote it down once and for all. And I think that will reclaim a lot of the space around it. So I think that's the first part of the two-pronged attack. The second one would be using antitrust laws, some of the RICO statutes, tax law to go after all of the NGOs and nonprofits, starting with the UN's PRI and the World Economic Forum, for what is clearly coercive behavior that's restricting commerce. They're trying to set energy and economic policy. They're actively regulating government officials, all of which is beyond their mandate. So I think there needs to be an aggressive push around all of these institutions. And these are the institutions behind a lot of these net zero alliances that you're seeing proliferate on Wall Street. And then I think just lastly, since climate change is the core of ESG, it would behoove everyone to read up and understand all of the fatal flaws in the climate data as well as the climate science, because that's an argument that we're going to finally have to have now. And if you look at the data, and I approach this as someone who's worked on Wall Street and looked at investments, I just took it from a layman's perspective. There are a number of fatal flaws in the data and the argument. And so if that doesn't hold, then everything that flows from it, sustainable development, ESG, should evaporate. Everything away from climate change when it comes to ESG is just random progressive goals that have been accumulated over the years. So if we win on climate, we win on ESG. So I think that should be the focus of lawmakers going forward.
So finally, we call our podcast Next Round because of PRI's proximity to wine country and our love of discussing public policy over a great glass of California wine. So what wine, beer, cocktail, or other beverage are you enjoying these days to celebrate the publication of your terrific new book?
Okay, so I will give you a range or a selection. My beer of choice would have to be Coors Light. Since we've been talking about ESG, I feel compelled to say I've never really been a drinker of Bud Light. When it comes to wine, my go-to is a Chardonnay from La Crema, Russian River. I think that's out your neck of the woods, so that's close to home. But for publishing my first book, that's kind of a milestone. So I think we have to go a little more special. So I've been gifted pricier bottles of champagne over the years, and I've been keeping them to dust off around a special occasion. So I think this qualifies. So I'm going to have to go with a Perrier Jouet brewed champagne. I think that's my final answer.
Thanks so much. Great choices. If you like this episode, please tell your friends and subscribe to PRI's podcast at iTunes, Google Play, Stitcher, TuneIn, iHeartRadio, and Spotify. And when you're on these platforms, don't forget to give us a big 5 stars. If you don't subscribe to any of these, you can still listen on PRI's YouTube page, youtube.com/Pacific Research 1. That's the number 1. Thanks for listening. I'm Rowena Itchon. Hope you'll come back again for Next Round with PRI.